Good afternoon. It is December 9th of 2021, and there are now just around 3 weeks left until the new year. And given all of the market volatility that we've had this year, especially here in the last couple of weeks, I'm sure there's just a lot of people out there that can't wait to start the calendar year anew. Now, the good news is that despite the volatility we experienced from Omicron and the Federal Reserve and inflation fears, week over week, we're actually up, believe it or not. And that's really what triggered our buy signal last week, was that degree of panic. Now, tomorrow, which is probably when this video is going to go out, we're going to get the CPI report, the inflation report. The market is really spooked about it, is very concerned about it. We've really tried to barbell the portfolio so that it doesn't matter what inflation does. Hey, if we get a little bit of disinflation, we got a little bit of technology exposure. If we get inflation, hey, we got our core energy and consumer exposure that will work well during times of inflation and disinflation. So that's what we're going to go through this week. The title of this week's market update is Here Comes Inflation. We know that's the biggest fear out there across our client base, across our advisor base. And it's something that we want to really coach clients through, because we want to focus on companies that at the end of the day don't need to depend on inflation or disinflation in terms of their level of success. Because it's guessing, right? What is CPI going to do tomorrow? Who knows, right? I think it's projected to come in around 6.8%. If it's 6.7, the market probably rallies quite a bit. If it comes in at 7, we probably have a little bit of a sell-off. But the truth is there really a big difference in our lifestyle that we experience day to day, whether it's 6.7 or 7.0? Not a lot, but from the investment game, there could be. So what we really want to focus on this week is, let's focus on the points that we know, not on what we think. And that will really help us create a portfolio in terms of what we call an all-weather type of portfolio. So the three big things that we're going to talk about this week: what drove last week's buy alert? Number two, how is the economy faring through the current inflation surge and some of the volatility and uncertainty of the past few weeks? And lastly, where do we want to put our money to work after we get these pullbacks, right? We can easily say, hey, go buy stocks. Well, which stocks, which sectors? So we're going to go through that today. So what drove last week's buy call? So when we came into the office later in the week, Wednesday, Thursday, what we noticed is that implied volatility spreads were back to levels that we didn't see since March of 2020. And we also had 2 days in a row where 90% of stocks were down versus up. Those are typically short-term capitulation factors that we always look for during market pullbacks here. Now, why is looking at the VIX or volatility so important? It's important because we know historically over the last decade, whenever we've had volatility above 30 and we invest and buy stocks when the VIX is above 30 days later, we typically, on average, have had about a 6% gain in the stock market. That's important. This is stuff that we have to be mindful of, because fear provides opportunity. VIX has breached 30 9 times over the last decade. 8 out of 9 times, we've had a 6% or greater return over the next 30 days. The only exception was March of 2020. Now, the only difference is when VIX crossed above 30 in early March of 2020, we had about another week of pain after that, which is fine. It still proved to be a great buying opportunity. So in other words, when VIX gets above 30, every once in a while you might be early, but more times than not, it's a great time to put money to work. And we know that panicking has consequences. The chart on the right is the S&P 500 over the last week and a half. Again, this is not including Thursday. So what do we see here? A quick 5.2% sell-off in the S&P 500 before we close the gap all the way up to just 1% below that all-time high. What happens many times is that clients panic based on headlines, and they sell down here and they say, I just want out for a couple of weeks and then I'll get back in. But guess what happens? 4 days later, we're back to within earshot of the all-time high, and then the clients come back in, or the investors come back in. This is not just clients, by the way. These are portfolio managers, traders. This happens all the time. So what does this really mean? You just locked in a 5.2% loss. If you had $1 million invested, that means you locked in a $52,000 loss. This is not chump change. And the problem is this doesn't happen once. It happens many times throughout the year and throughout the years on a client's course and an investor's course to retirement. And this takes years off our money. In other words, as opposed to running out of money when you're 95, you're running out of money when you're 80. Why? Because of all these series of paper cuts along the way. We want to avoid investing based on fear, investing based on headlines, and investing based on the unknown. And what we also know is that each successive wave that we're getting of COVID, it's having a less and less impact, material impact on the market. This was the original COVID outbreak, the blue line. So we had about a 35% drawdown, and it took approximately 25 weeks and 6 days to get back to break even. Now, the second wave was even less than that. It was around 10 weeks and 2 days, and we had about a 9% drawdown. Then we had Delta, a 5% drawdown, and it took about 7 weeks to recover. So far with Omicron, we've had about a 5% drawdown, but it took only so far about a week and a half to recover back to break even. So again, whatever causes that original bear market, that cause typically does not repeat itself to cause the next bear market. It's usually the thing that we're not looking out for that hurts the stock market. Now, in terms of the market this week, we've had really, really solid breadth. So as the markets recover, we've seen that advanced decline line thrust upward, and bringing in more stocks along for the ride. Now, growth stocks remain an area of concern. We see it with the ARK funds, where on any given day, that fund could be down 5, 6, 7%. It's taking down a lot of high quality growth stocks with it. So you will notice in the portfolio this week, we did introduce a couple of technology names. Why is that? Because as these ARK funds and similar growth related funds sell off, they're taking some really high quality merchandise down with them. You know, kind of just randomly think of names such as the Trade Desk or Shopify, or names that we don't own, such as Google or whatever it is. You know, these are areas of opportunity where things are getting thrown out with the bathwater. So we want to be opportunistic. Now, you will notice, this is the real caveat here, between now and the end of the year, you will see some trading activity in the portfolios. Why? We're going to do some tax loss selling for names where over the last week have been hit by volatility, and we can actually switch that exposure to a similar name, lock in the loss, but at the same time, keep that exposure intact. So keep an eye out for that. If you see it, that's what's going on. Now, number two, on this chart on the right over here, the other thing that we are seeing is that as the percentage of issues above the 10-day moving average became very oversold, we're now seeing that bounce back. So we're in that first percentile in terms of the number of stocks that were trading above the 10-day moving average was down to 1%. So when you get those levels, plus the VIX that we saw before, those are real signs, tangible signs that we're in a very oversold market. We remain pretty oversold despite some of the rally we've had over the last couple of days. We'll see what happens tomorrow. What happens tomorrow is not significant from the long-term perspective, but the market will be watching those CPI numbers. Now, from an economic perspective, things are going fantastic, and don't let anyone else tell you differently. When we look at the ISM manufacturing and we look at the ISM services index, two things stand out. We are in the quadrant on the top right, that top right quadrant. That signals an acceleration and an expansion. right? So not only is the manufacturing and service economy expanding, but it's actually accelerating upward and to the right. So what's really happened over the last month? I think it's important that we actually summarize all these points so that clients and investors and advisors really understand what's going on. Auto sales went from down 25% in September to down 20% in October to down 17% in November. That is what we call a deceleration of contraction. So in other words, the second derivative is getting better. It's getting less bad. What is supporting that? Now you'll notice we own a couple of auto manufacturers, but what is driving that? What's driving that is the supply, the chip supply shortage is getting less bad. That's important because remember, that's been driving part of inflation. Number two, mortgage demand accelerated to a 9-month high. Doesn't happen during recessions. Number three, non-farm payrolls increased and US jobless claims, guess what? 54-year lows in the jobless claims. Remember where we were just about a year and 10 months ago in March of 2020 with 22 million Americans filing for unemployment? We were under 200,000. This is an incredible feat for the country. It doesn't matter which political party that you align yourself with. Both parties, if there's one thing they've been successful with, it is working together and making sure that we get out of the worst part of that COVID recession. Number four, aggregate labor income accelerated to 9.1% in November. People are making more money. Guess what? Aggregate income increased 9.1%. Inflation's at 6.5. Yeah, it kind of sucks that inflation's high, but fortunately, people are making more money than the pace of inflation. That's good. ISM accelerated in November versus October to 61.1. 50 is that expansion versus contraction line. And of course, that services index hit an all-time high of 69.1. That doesn't happen during recessions. As we said before, jobless claims, 54-year low, job openings, right near an all-time high. So from a market perspective, commodities remain somewhat oversold. Now, when we look at that potential for a new turn in terms of where secular growth is going to take place, we really do think it's commodities. Now, you'll notice we've trimmed our oil exposure just a touch. Why? Because after the rally in oil, our portfolio was almost half in energy. So we had to trim that back just a little bit. But commodities remain oversold. These are the areas of enduring leadership strength in this current bull market. So we want to embrace that. So when we get those pullbacks in durable stock market leadership, those are buyable moments of weakness. Now we can see it here too. There's a lot of buying power for this space. Oil and gas as a percentage of the S&P 500 peaked at just around 13, 14%. It's gone all the way down to around 2%. Meanwhile, software is all the way up to 10%. We know that. We've been huge software investors over the last decade, but now the value is down here, not up here. So we asked the question, which Fang is right? Do you want to own Fang, Facebook, Apple, Netflix, Google, or do you want to own Fang, Diamondback Resources, right? Now, we're not making a call on the stocks. We're just saying, generally speaking, from a macro standpoint, is it energy or technology? When we look at the percentage of stocks hitting a 3-month high, relative high to the S&P 500 versus a 3-month relative low, the sectors that look most attractive are really energy, real estate, industrials, and consumer discretionary. The ones that look weakest are technology, healthcare, and communications and financials. So what do we want to do? When we see this type of action, we want to go back to the relative high leaders. We want to look at those industrials, those energy names, those consumer discretionary names. Those are the areas we want to buy the dip in. And of course, going back to COVID, what COVID? When we look at those TSA numbers, we're borrowing this slide from last week, but I just think it's so relevant because of what we hear in the press versus what is reality. What we hear in the press, everything's shutting down. What is reality? Everything is opening up. Pay attention to the data, get through the days of uncertainty and noise, and you'll make some money over the long term. So what are the bottom line messages for this week? So inflation might come in higher, it might come in lower tomorrow than expected, but that's why it's better to own assets that can thrive no matter what happens, right? we have no idea if it's going to come in above or below expectation. We do expect a deceleration over the next 12 months in inflation. What happens specifically tomorrow, who knows? That's why we want to own companies that can do well regardless. And we don't mean by the stock price going up or down tomorrow. We mean fundamentally the cash flows that they're making year over year. So 3 big takeaways. We want to use those bouts of market fear to increase exposure to those areas of stock market leadership. The US economy is accelerating, not decelerating. We're in expansion, not recession. We got to remember that. Lastly, commodities remain an area of durable stock market leadership. Thank you so much again. We have one more weekly update before Christmas and the holiday season. So please stick around for next week. We will provide one more update. We are off the following 2 weeks, but we will be completely active on Twitter, the LPAM Investments. Please follow us if you want to get those daily market updates. So thank you again and have an absolutely fantastic weekend. Thank you.